By 2013, Detroit owed an estimated $18 billion in total obligations. Of that, approximately $3.5 billion was unfunded pension liability. That is the gap between what the pension fund actually had in it and what the city had promised to pay its retirees. 30,000 people, 30,000 former city workers who had given careers, in some cases entire working lives, to Detroit, suddenly found themselves listed as creditors in a federal bankruptcy case. Not citizens, not pensioners, creditors, like banks and bondholders. The retired general city workers eventually accepted a cut of 4.5% to their base monthly pension. They also lost their annual cost of living adjustments permanently. Those adjustments are the small percentage increases that are supposed to keep a pension from being eroded by inflation over time. Without them, a fixed monthly payment slowly buys less and less every year, not because of a dramatic collapse, but through the quiet, steady pressure of rising prices. For police and fire retirees who did not receive Social Security benefits and therefore depended on their pension as their only safety net, the cuts were initially proposed at 10%. A man named Roderick Vale, who had worked for the city of Detroit for 33 years, tried to retire early in 2012, specifically to lock in his pension before the crisis hit. He made the right call. He got his pension. But tens of thousands of others did not have his timing or his foresight. The pension guarantee had become a negotiation. In a courtroom, 30 years of work reduced to a line item in an insolvency proceeding. Most people will never know what you now know. Most people will spend their entire working lives believing that a pension guarantee is a guarantee in the same way a padlock on a vault is a guarantee. They will never look at the fine print. They will never understand that what governments and municipalities call a pension fund is often just a system of obligations with a funding gap that grows a little larger every year. If you are still here at this point in this video, you are not most people. You are someone who wants to understand the world as it is, not as you were told it would be. Hit subscribe, because the section coming up now is the part this channel was made for, the part they never put in the textbooks. The moment when you look at all of these events together and realize they are not separate tragedies. They are the same story, told in different languages, in different decades, on different continents. Now observe what all of these cases have in common. Soviet pensioners in 1992, Argentine workers in 2008, Detroit retirees in 2013. Three very different places. Three very different political systems. Three very different economic structures. And yet the same mechanism runs through all three like a wire through a wall. Hidden, structural, inevitable once the conditions were in place. In every case, the people who lost were people who had done exactly what they were told. They worked, they contributed, they trusted. They did not speculate, they did not gamble. They followed the rules precisely as they were written. And in every case, the entity responsible for honoring the promise found itself in a situation where the cost of honoring it was higher than the cost of breaking it. In every case, the promise was broken, not maliciously in every instance, not with evil intent, but it was broken just the same. The same mechanism, different countries, different decades, the same result. And here's the piece of this that is almost never discussed. The funding gap, the gap between what the system owes and what it actually holds, does not appear overnight. It builds slowly for years, sometimes for decades, while official reports describe the system as healthy, while actuaries, which are the experts who calculate these kinds of long-range obligations, use assumptions that require the investments to grow at rates that history does not always support. In the years before Detroit's bankruptcy, the pension fund was projecting investment returns of around 8% per year after year, every year, in a world where interest rates had been falling for decades and government bonds were paying almost nothing. The math was built on hope, and when hope met reality, the gap appeared. This brings us to something deeper, to the human face of what these numbers mean. Because at some point, the economics stops being about percentages and starts being about people. In Greece, between 2010 and 2015, pensioners endured 11 rounds of cuts to their retirement payments. 11, not one dramatic announcement. 11 successive negotiations, bailout packages, austerity programs, troika requirements, technical adjustments, each one taking a little more. By 2015, pensions had been cut by an average of 27% compared to 2010. For the highest earners, the cuts reached 50%. Half of what they had been promised was simply gone. By the time of the peak of the Greek crisis in 2015, an estimated 45% of Greek retirees were living below the poverty line. Nearly half of all retired people in the country could not cover their basic costs from their pension income alone. The human details are what stay with you. Doctors and lawyers in their 70s waiting in bread lines, families moving elderly parents into already crowded apartments to pool costs, a 62-year-old woman in Thessaloniki who had worked as a teacher for 30 years, earning a pension that was cut from 900 euros a month to less than 500. She could not pay rent. She could not afford medication for her blood pressure. She moved into her daughter's spare room. She told a Guardian journalist in 2015 that she felt ashamed, not angry, ashamed, as though she had done something wrong. She had not done anything wrong. She had done everything right. On the other side of the world, in Chile, a different version of the same tragedy was unfolding more slowly. Chile introduced its privatized pension system in 1981 under the dictatorship of Augusto Pinochet. Workers were required to put a portion of their wages into individual private investment accounts. The theory was elegant. Your money grows with the market. You build real wealth. When you retire, you are financially independent. The system was praised internationally for decades as a model of pension reform. And then the people who participated in it for 40 years retired. And by 2016, roughly 45% of Chilean retirees were living in poverty or near poverty. The average pension payment was equivalent to less than half the national minimum wage. Workers who had contributed faithfully for decades found that their accumulated savings, after 40 years of contributions and investment growth, were simply not enough to fund a dignified retirement. The arithmetic, stretched over a lifetime of lower than projected returns and longer than expected lifespans, did not work. Hundreds of thousands of people had done exactly what was asked of them and arrived at retirement with almost nothing. The system had not been stolen. It had not been bombed or seized. It had simply failed to deliver on its implicit promise. In October 2019, this failure was one of the central triggers of the largest social uprising in Chile's democratic history, with millions taking to the streets across the country. The question is not whether this pattern will repeat. History has already answered that. These are not random events. They are symptoms of a structural problem that exists in almost every pension system on Earth today. Right now, in 2024 and 2025, the aggregate unfunded pension liability for state and local government pension plans in the United States alone is estimated at somewhere between $1.5 trillion and $1.6 trillion. The Geneva Association, a global insurance and pension research organization, estimated that the worldwide pension gap, which is the difference between what pension systems have promised and what they actually hold, reached $41 trillion. These numbers are so large they stop feeling real. But they are real. And somewhere in those numbers are the retirement years of real people who are working right now, contributing right now, trusting right now. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing. And it might change everything you think you know about your own financial future. The historical record does not offer comfortable answers, but it does offer patterns. And patterns, if you understand them clearly enough, become a kind of protection. Across every case study in this video, from the Soviet pensioner in 1992 to the Chilean worker in 2016, a consistent picture emerges of who came through these events in better condition and what those people had in common. And to be absolutely clear, this channel does not offer financial advice. What follows is not a prescription. It is historical observation, a description of patterns, nothing more. The first pattern that appears consistently is this. The people who suffered the least were almost never the people who had placed all of their trust in a single promise made by a single entity. In Russia, those who had accumulated physical assets, land, property, items of real-world value, something that hyperinflation could not reduce to zero on a spreadsheet, had something to fall back on when the ruble became confetti. A family with a small dacha, a country home, and a kitchen garden did not eat as badly as a family whose only asset was a savings account that inflation evaporated overnight. In Greece, the people who navigated the crisis without falling into poverty were often those who had kept savings outside the Greek banking system entirely, in bank accounts in Germany or Switzerland, or in physical assets that did not depend on the Greek government's solvency. They had not done this because they were cynical. Many had done it simply as a matter of family tradition, a habit inherited from relatives who had lived through earlier Greek crises in the 1940s and 1980s. The historical record suggests that intergenerational memory about financial crisis is a form of protection. If your parents or grandparents told you stories about the time when everything promised to them disappeared, and if you listened, you carried a different understanding of what promises mean. In Argentina, the workers whose retirement accounts were most protected from the 2008 nationalization were those who had moved assets into real estate, into dollar-denominated deposits held outside the country, or into physical gold in the years before the seizure. Not because they foresaw the seizure specifically, but because they had lived through Argentina's 2001 default and understood from direct experience that the government was capable of rewriting the rules without warning. Experience was their advantage. In Detroit, the retirees who fared best were those who had supplemented their city pension with personal savings, whether through a private retirement account, a spouse's income, or real estate. The pension cut of 4.5% was painful for everyone. But for someone whose pension was their only income and their only asset, it was devastating. For someone who had built a second layer of financial security alongside the pension, it was a serious setback and nothing more. The The difference between devastation and setback was not intelligence. It was not privilege. It was the presence or absence of a second foundation beneath the first. The second pattern is less obvious, but just as consistent. The people who came through pension crises in better shape were generally those who had maintained financial flexibility throughout their working lives. Liquidity, the ability to access funds quickly without being trapped in a single system, mattered enormously when systems failed. When Greek banks limited withdrawals to 60 euros per day, the people with assets outside the bank, or with foreign currency in cash, or with real property they could rent or sell, had options. The people whose entire financial life existed within the Greek banking and pension system had none. The third pattern, and perhaps the most uncomfortable one, is this. The people who survived best were the ones who had not confused the legal existence of a promise with the practical certainty of its fulfillment. They understood, either through education or through experience or through listening carefully to history, that a pension guarantee is a political document as much as it is a legal one. And political documents can be renegotiated when the cost of keeping them becomes higher than the cost of breaking them. This is not cynicism, it is clarity. And clarity, as the historical record shows again and again, is worth more than comfort. Now let us return to where we began. Georgos, the retired pharmacist in Athens, in the summer of 2015, he lived through the bank closures. He lived through the withdrawal limits. His pension was frozen for weeks and then reduced. By the end of 2015, it had been cut by more than 30% from what it had been just 5 years earlier. He told a journalist at the time that the hardest part was not the money. The hardest part was understanding that the contract he thought he had made with society, the deal that said if you work hard, contribute faithfully, and follow the rules, you will be taken care of, was not actually a contract in the way he had understood it. It was a framework, a set of intentions, an arrangement that held only as long as the conditions that created it also held. Georgos was not naive. He was not irresponsible. He was not unlucky in the random sense of the word. He was a participant in a system that had been moving toward this outcome for decades before 2015, quietly, invisibly, while every official report described it as sustainable. The pension trap does not announce itself. It does not send a warning letter. It builds in the space between what is promised and what can actually be delivered. Year after year, election after election, actuarial report after actuarial report, until the gap becomes too large to ignore and too expensive to fill. And at that point, the person sitting on the other end of the promise, the worker, the retiree, the person who did everything right, is the one who pays the difference. This video is historical and educational analysis. It is not financial advice. Every individual situation is different, and every country's pension system operates under its own specific legal and economic conditions. Nothing in this video should be taken as a recommendation to take any particular action with regard to your personal finances. Please consult a qualified financial professional before making any decision about your retirement planning. History does not repeat itself exactly, but it rhymes with a consistency that is impossible to ignore once you have heard the melody enough times. The Soviet pensioner of 1992, the Argentine worker of 2008, the Detroit retiree of 2013, the Chilean contributor of 2016, the Greek pharmacist of 2015, they are not the same story, but they share the same architecture, the same foundational vulnerability, the same gap between what was promised and what was delivered. This video is not for everyone. Most people will watch something else. Most people will find this too uncomfortable to sit with for long. But if one person in your life, a parent, a friend, a colleague, someone who is counting the years to retirement with quiet confidence, needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more of this kind of historical clarity, and I will see you in the next one.